What's the best way to build wealth? Z. Picking the next hot stock? Not quite. Norse. People get stuck on that idea, but successful investing really boils down to two main strategies: dividend investing and growth investing. Fours. Which one actually makes you richer over time? Let's break it down and find out. First, let's talk about dividend investing. 2. This strategy is all about generating cash flow. Vets. You invest in established companies or ETFs that share their profits with you in the form of regular payments called dividends. Think of popular choices like SCHD or Realty Income. If the idea is simple, you earn money just for holding your investments. It's like getting paid a small salary from your portfolio. And the best part, you can take those dividends and reinvest them to buy even more shares. Over time, this creates a powerful snowball effect, where your investments generate bigger and bigger payouts. It's a slow and steady path to building wealth, but incredibly reliable. On the other side of the coin, we have growth investing. V. This strategy focuses on increasing the total value of your portfolio. V. You buy into companies or ETFs that are expected to grow much faster than the overall market. Classic examples here would be an S&P 500 index fund, like VOO, or maybe a tech-focused ETF. With these investments, you might get very small dividends, or sometimes none at all. The real magic happens when the stock price itself shoots up. 2. Your wealth grows as the company expands and becomes more valuable. This path can lead to some seriously impressive gains, especially if you get in on the right companies early. So, dividend investing gives you that consistent, predictable income, while growth investing offers the potential for much larger gains, but with less immediate cash flow. Let's look at a simple example. 2. If you put $10,000 into a dividend ETF like SCHD, you might expect to receive around $300 to $400 in dividends each year. It's cash in your pocket. Now, if you put that same $10,000 into a growth-oriented ETF like VO, and the market goes up by 10% that year, your investment could grow by $1,000 or more. The wealth is there, but it's locked into the value of your shares until you decide to sell. Now, here's where it gets interesting. Both strategies harness the power of compounding, but they do it in slightly different ways. Thrill. Secret weapon for dividend investors is dividend reinvestment. Then you automatically use your dividend payments to buy more shares. Turn. You're not just earning a return on your initial investment, you're earning a return on your returns. This accelerates your portfolio's growth significantly. Over a few decades, this compounding snowball can actually rival the total returns of many growth strategies. 2. It might start slower, but its long-term power is undeniable. When it comes to risk, there are also some key differences. Growth stocks tend to be more volatile. Their prices can swing up and down dramatically based on market news and economic forecasts. Dividend stocks, on the other hand, often provide more stability. Because they're typically larger, more mature companies, their stock prices tend to hold up better during market downturns. While a growth ETF might drop sharply in a correction, it could also recover much faster when the market bounces back. So, your choice really depends on your personal goals and how much risk you're comfortable taking on. There's no single right answer here. Dividend investing is fantastic for generating steady income and achieving long-term stable growth. Growth investing is ideal if your main goal is to maximize your total net worth over time, and you can handle the ups and downs. But here's a pro tip. Many of the wealthiest investors don't just pick one. They combine both strategies. They use dividend stocks to create a reliable income stream and then use index funds or growth ETFs to capture that massive long-term growth potential. It's truly the best of both worlds. So, what's the takeaway? First, decide what your primary goal is. 2. Need cash flow now, or are you focused on building the biggest possible nest egg for the future? Second, no matter which path you choose, Start as early as you can. Compounding needs time to work its magic. And if you go the dividend route, make sure you're reinvesting those payouts to maximize your growth. Finally, don't get distracted by hype or chase the latest hot stock. Consistency is what builds real, lasting wealth. So, will it be dividend investing or growth investing for you? Thrites. The right strategy is the one that aligns with your personal financial journey. Few want more simple, actionable tips to help you grow your wealth. Make sure you subscribe to Next Gen Invest. We're here to make investing simple for the next generation. Thanks for watching, and I'll see you in the next video.